Hey everybody, Marty Mazur. Good morning, March 22nd, 2018. Video commentary for you. Posted a couple of things already this morning. One was kind of setting you up for today and for this volatility that we're seeing right now. We saw it coming in the futures market, pre-market, and I talked about Boeing and how important its business in China is to it as a company. And of course, Boeing is the biggest impactor on this big drop that you've seen in the Dow so far. Talk about just general conditions because that is what we spend our time on here at PWA. I've been doing this for 34 years, believe it or not. Have seen a lot of things during that time. Got to experience firsthand the big drop back in 1987. 1994, big bond bear market, huge volatility in the mid-90s. We had a Mexican currency crisis. We had the Thai currency crisis. We had the Russia default. We had a huge hedge fund implode. All of it sparking the kind of volatility and some that we're seeing this morning. So we expect it. As I said in a blog post this week, folks, if it wasn't this stuff, it would be other stuff. We're going to have volatility even in the best of bull markets, and that's what we're experiencing right now. We did mention going into this year, we thought the thing that would spark the greatest amount of volatility is exactly what we're seeing right now. The question is it the kind of thing that can derail the bull market? Well, the good news is historically bull markets don't just end overnight. So it takes time, and you begin to see in the technicals as well as the fundamentals certain breakdowns. So what we do is look for those breakdowns, and if we don't see them, we don't impose much in terms of shifts within client portfolios. But when we do start to see them, we will incrementally over time begin to get more defensive. We're just not seeing that just yet, as I'm going to illustrate for you here in a second. The chart in the center of your screen is the 5-year daily chart for the S&P 500. This is that 2-year, we'll call it consolidation period between 2014 and 2016. Essentially within the context of the overall market, we just had a long sideways period, and that market goes through that from time to time. We like to use the term consolidation. We had nice gains, needed to be digested, had some corrections along the way, broke out of it here, and here we sit today. These are our 50, 100, and 200-day moving averages, which are trend indicators. They're all sloping in the right direction. You can see there's been some testing of those. That was the correction that we've already had this year, testing the 200-day moving average. You can see that held and so on. But there have been times when even these trend indicators have been breached still within the context of an ongoing bull market. Here we are as of Monday. Of course, today that would be coming back down, and I'm sure testing some lower levels, looking at where the market sits as I speak here this morning. So looking historically at closely correlated markets, last year in 1995 looked very similar. In fact, here we are on 3/19 of 1996, presumably the same time where we sit today from a correlation standpoint. We also had about a 2-year consolidation period going into 1995, had some volatility. As it turned out, this was about halfway through what is still the longest bull market in history. So if we line these up side by side, here's the current 5-year chart. Here's the 5-year chart in the 90s, March of 1996. And the circle right here is where we happen to be right here in 1996. So we had, several years, a good 4 years left to go, 4+ years, before the market finally rolled over. Now, folks, I am not promising this. I am not predicting this in any way, shape, or form. I'm just telling you that it's within the realm of historic possibilities that this bull market actually has a ways yet to run. But look at the volatility as it continued to run. Here was 1998 when we had just an intense period and a big 20% correction, but we still had a long ways to go. Reacting in here to the noise, to the volatility, the stuff that was quite frankly scarier than what we were experiencing this morning would have been very detrimental because there had been big whipsaws and it had been tough to get back in if you happen to panic and sell out at that point. Our weekly moving average trend indicator updated as of last Friday. Short-term moving averages versus the long are exactly where they should be. The slopes are all bullish. This is where we were again as of last Friday. Here's where we were at this very point during the longest bull market in history. So basically time-wise, we're this far along now. Time-wise back then, we were this far along as of 1997. So actually the correlation before was a little earlier. So right now in terms of length, this is where we would be. You can see a similar look. Actually, it's similar look getting into this point for the markets. Here's where we happen to be during the longest bull market ever. So again, it's within the realm of historic possibilities, as I keep saying, that we could go further with a lot of volatility along the way. Here's how those long-term moving averages, those weekly moving averages look prior to bear markets. So here they were rolling over before the tech bubble bursting, before the real estate bubble bursting. Here's a couple of signals that might have been false signals that people might have reacted to, and if they did, they would have got whipsawed, which would have been very ugly. When we backtest our macro index and we backtest it to these points, we can see that before the market rolled over, our index was actually pointing to probabilities that things were about to get worse for the equity market, and sure enough, they did. Here during these signals, where you might call them false signals, you can see that even though that was a low number, it was still in the green, which means on balance, we still had a bullish macro setup, even more so in here in a very difficult time, two back-to-back corrections in late 2015 and early 2016. Our monthly Bollinger Band long-term trend indicator, which has been excellent historically. The middle line here is the 20-month moving average, 2 standard deviations above and below. When we break down below it, that's a sell signal for technicians who want to react. We would tell you that until the moving average actually rolls over, it's not, because you can see you get these false signals in here. But see it break down below the price and then roll over prior to the tech bubble bursting, and look what we got. You can see it testing it, testing it, testing it. Then you see it breach it, but then you see it roll over, and look what we got. It would have been good for investors to get somewhat defensive in here relative to where they probably were back in here. And it would have been good. They would have mitigated some of the downside in both of those bear markets. Here we are since. You can see it breaching it back here in 2011. No rolling over the moving average, though, still an upward slope. Here we were with those two back-to-back 10+% corrections. Absolutely nothing that looks like a rolling over the moving average. And here we are currently. So folks, if you compare this look to previous looks historically, you realize that this is a very bullish look. And despite what's going on outside of the market, when you look at the internals, this tells you that if you're a long-term investor, that you're not a swing trader or a short-term market timer, that right now you do not get defensive. You wait for things to break down from a macro fundamental basis before you begin thinking about getting defensive and hopefully mitigating some of the bear market if you're a patient long-term investor. Okay, so as for the latest in our macro update, this is as of Monday. The index scored a 61.73, 81 indicators that span consumer data, business data, general economy, inflation data, commodity trends, our financial stress index, we call that our bubble index, financial markets, which is the most volatile component. We track things like overall market breadth as well as sentiment and so forth. So this one has the widest swings. You can see the week before it was 52. This last week it was a 38, which is still a strong reading. But for the most part, it was the financial market indicators that actually brought us down to 61.73, which, as you can see in our back testing here, was actually historically a very high score. Here was a period of a lot of volatility in the late 90s with our index back test scoring at 23, so we still had a ways to go. Here we are pretty much at all-time highs, but the index was breaking down, and then we can see what happened here. Here at the bottom, it was turning green again, starting to even before. Had a good run right here at the top, all-time highs again. You can see the index rolling over, which means the majority of the indicators back here were flashing red and signaling that the economy has some issues and that the risk is probably greater to the downside going forward. And then since then, we've had this second longest bull market in history. We've had a lot of volatility at times, but we never had a breakdown in the macro index. And as you can see right now, we are still at a historically very high 62, instructing us not to react to this kind of volatility which we're seeing right now in the market. Summing it all up in terms of the indicators that I've shared with you today, here are again those weekly moving averages. We added the price here of the S&P 500. Folks, when we have this look in the technicals, when we have the fundamental look with our index that I just talked about, we are in a period where we want to maintain a growthy asset class and sector allocation until the weight of the evidence changes, and we will always expect and accept volatility during these periods, but we want to stay on this course as long as the data is informing us to. When it breaks down, when the technicals begin to roll over like this, when the fundamentals are giving us negative readings in our index and all the other things that we look at, then we want to change our posture toward the market. Then, of course, we want to maintain a defensive asset class and sector allocation, again, until the weight of the evidence changes. It's going to be very imperative that we preserve principle during times like these, and we will no doubt suffer some drawdowns. But if we do a good job as investors and as advisors and account for what we're seeing in general conditions, then hopefully we'll do a good job of preserving more principal than we otherwise would, and you'll just kind of hang on and close your eyes approach and ride through all these things. Jesse Livermore, the subject of Reminiscences of a Stock Operator, written in 1923. In my view, the single best book, certainly the single best book I've read on how good traders and investors operate in the equity market. Not even a world war can keep the stock market from being a bull market when conditions are bullish, or a bear market when conditions are bearish. And all a person needs to know to make money is to appraise conditions. And the question today is, would a trade war keep the stock market from being a bull market when conditions are bullish? That remains to be seen, but we're going to have to see conditions become bearish before we begin reacting to presumably, to what could be a trade war going forward. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. So folks, that's kind of where we are today, as I just illustrated for you. And I just really scratched the surface with the data that we track literally week in, week out, day out. While there is always going to be some noise, while there are always going to be red flags in our data. In fact, we change those colors very quickly when things begin to break down in an indicator. What we're seeing right now suggests that we are still very much within an ongoing longer-term bull market. And I assure you that when we begin to see things break down in our data, in the facts, in the evidence that we have at our disposal, that's when we begin talking a different story here on the blog. And that's when you clients begin seeing some activity within your portfolios. It's just not the conditions that we see right now. We will keep you posted. Be lots more on the blog coming up. Thank you as always for watching and listening. Take care. Bye-bye.